Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast, where we cover the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, and today we're diving into some fascinating updates that could impact your next real estate decision. Our first story today is about the recent surge in Canadian building permits this past July, breaking a 2-month decline. This rebound is primarily driven by a renewed interest in multi-unit housing developments, according to Statistics Canada. The total value of permits jumped an impressive 22.1% to $12.4 billion, signaling a strong comeback for the construction sector. Both the residential and non-residential sectors contributed to this growth, but it was the multi-unit construction boom that really stood out. The residential sector saw a 16.7% increase overall, with permits for multi-unit buildings surging by 29.3% to reach $5 billion. This was a major factor behind the sector's overall growth, even as single-family housing permits dipped slightly by 1.9%. British Columbia experienced the biggest jump in multi-unit permits, with a staggering 152.1% increase, amounting to $766.8 million. This surge was largely driven by projects in cities like Richmond. Alberta and Ontario also contributed significantly, with increases of 33.1% and 7.7% respectively. StatCan reported that a total of 20,700 new dwellings in multi-unit buildings and 4,100 new single-family dwellings were authorized in July. For the 12-month period from August 2023 to July 2024, a total of 260,200 new units were authorized across Canada. This highlights a consistent demand and growth in the housing sector. The non-residential sector also showed strong growth, with the total value of permits rising 31.8% to $4.8 billion. This growth was seen across all components. Commercial permits increased by 18.4% to $2.2 billion, industrial permits surged by 98.6% to $1.3 billion, and institutional permits rose by 14.8% to $1.3 billion. Ontario led the non-residential sector growth with a 23.8% increase to $2.2 billion, driven by gains in the industrial component, which rose 99.3% to a record high $678.3 million. This was supported by construction intentions for the expansion of a tire manufacturing plant in Greater Napanee and broad-based growth throughout the province. British Columbia also saw significant growth in the non-residential sector, with an increase of 99.2% to $869.1 million. This was due to large gains across all components. Industrial permits rose by 349.2%, institutional by 383.0%, and commercial by 30.8%. On a constant dollar basis, using 2017 as the base year, the total value of building permits in July was up 22.9% compared to the previous month and rose 3.4% year over year. This indicates strong growth in construction intentions across Canada. Our next story focuses on the recent changes announced by Finance Minister Chrystia Freeland to some mortgage rules in an effort to make housing more affordable. On Monday, Freeland revealed a series of adjustments aimed at easing the housing crisis, although opinions are divided on their potential impact. One of the most significant changes is the increase in the cap on insured mortgages. Starting December 15th, the cap will rise from $1 million to $1.5 million. This change will allow more people to buy a house with a down payment below 20%. Previously, Canadians who did not pay at least a fifth of the cost of the house as a down payment needed to take out mortgage insurance, but the insurance was only available for homes priced at $1 million or less. Now that limit is $1.5 million. Additionally, the government is expanding the criteria for 30-year mortgage amortizations. Previously, the 3-decade amortization period was limited to first-time buyers purchasing newly built houses. Under the new rules, first-time homebuyers and buyers of newly built homes can now take out loans for a 30-year period. Freeland stated that these measures will incentivize more new housing construction and tackle the housing shortage. The announcement has sparked mixed reactions from analysts. Penelope Graham, a mortgage expert at ratehub.ca, believes that expanding the criteria for 30-year mortgage amortizations and increasing the insurance cap will greatly improve first-time homebuyers' access to the housing market. However, she also noted that it is unclear how these new rules would improve affordability for those coming up on their mortgage renewals. Marc Desormeaux, a principal economist with Desjardins, shared a more cautious perspective. He stated that while the changes will benefit some home buyers who can enter the market once the policy takes effect, there is a broader societal risk. According to Desormeaux, these measures could stimulate home buying demand, put more pressure on prices, and ultimately worsen affordability in the long run. The changes have also faced criticism from Toronto realtor John Passalis, who called them a terrible policy. Passalis argued that these adjustments are a quick fix designed to increase home sales and satisfy younger buyers, but they do not address the root causes of the housing crisis. The reality is that there's no quick fix to our housing crisis, Passalis said. The housing crisis is going to be solved with long-term measures. Home-building groups have lobbied for longer amortization periods to boost construction, arguing that more homebuyers in the market would encourage developers to build more homes. However, Desormeaux pointed out that there are many factors beyond demand from first-time homebuyers that are holding back home-building ambitions. These include a lack of skilled labor in the construction sector and the high cost of building. Prime Minister Justin Trudeau's polling numbers have recently slumped to an almost all-time low of 30%, a situation that analysts and economists attribute primarily to the high cost of homes and rents. With more people wrestling with these high prices, the Liberal government is under increasing pressure to find effective solutions to the housing crisis. Our next story covers the stability in Ontario's real estate prices for August, with some notable exceptions. Ontario home prices remained stable in August compared to July, continuing a trend of broad stability that has been observed since February. These figures were released by the Canadian Real Estate Association. On a year-over-year basis, the average single-family home in the province sold for $955,000 in August, which is down 5.2% from the average of $1,013,400 in August of 2023. However, the Halton region tells a different story. In Halton, most prices are actually declining. Specifically, single-family house prices in Halton were down 7.5%, condos were down 8.2%, and townhouses were down 4.7% compared to August of 2023. It is important to note that these numbers are seasonally adjusted and do not take inflation into account. Inflation, depending on the measure you choose, is running between 3.4 and 3.7%. CREA senior economist Sean Cathcart commented on the situation, saying, "Despite some fledgling signs of life to kick off the long-awaited monetary policy easing cycle, Canadian housing market activity still looks to be stuck in the same holding pattern it's been in all year." On a province-wide basis, condo prices fell 7.5% year-over-year, and townhouse prices fell 5.6%. CREA Chair James Mabey added, "With more interest rate cuts now expected between now and next summer, the stage is set for a faster return of demand, but we're clearly not there just yet." Within Ontario, sales in the north continued to show stronger growth than those elsewhere in the province. Single-family homes in Sault Ste. Marie were up 3.7% year-over-year, and those in North Bay were up 4.5%. Our final story today focuses on the national housing market, which is currently in a holding pattern, as buyers remain patient for lower mortgage rates. According to the Canadian Real Estate Association, the number of homes sold in August fell by 2.1% compared to the same month last year. However, on a seasonally adjusted month-over-month basis, national home sales edged up 1.3% from July. Sean Cathcart, the senior economist at the Canadian Real Estate Association, explained that with more favorable interest rates expected later this year and into 2025, it makes sense that prospective buyers might continue to hold off for improved affordability. "Prices are still well behaved in most of the country," Cathcart added. James Mabey, the association's chair, noted that the first weeks of April, May, June, and September typically see a burst of new supply that can jolt the market. This year, the Bank of Canada announced its third consecutive cut to its key interest rate during the first week of September, reducing it by a quarter percentage point to 4.25%. Mabey believes this move could help lure buyers off the sidelines. Economic forecasts suggest that the central bank will likely continue cutting its key lending rate by a quarter percentage point until July 2025, bringing it down to around 2.5% by that time. Desjardins economist Carrie Norman said, "Shelter remains the largest component driving inflation. The Bank of Canada will be watching closely to see whether the 3 recent interest rate cuts result in a significant increase in home prices, but so far, prices have been well behaved." The national average sale price for August amounted to $649,100, a modest 0.1% increase compared to a year earlier. On Monday, the federal government announced changes to mortgage rules aimed at helping more Canadians purchase their first home. As of December, the price cap for insured mortgages will be boosted from $1 million to $1.5 million. Additionally, the government will expand its 30-year mortgage amortization to include first-time homebuyers buying any type of home, as well as anyone buying a newly built home. Mike Heddle, a broker for Royal LePage State Realty in Hamilton, Ontario, observed some encouraging signs that a rebound could be on its way. Showings in the region have been on the rise over the past couple weeks after a slowdown in that metric through August, Heddle said. "Before the property's sold, we've got to generate offers. Before we generate offers, we've got to generate showings. If there's a leading indicator in the marketplace, that might be one of them." The number of newly listed properties was up 1.1% month over month, led by a boost in new supply in Calgary. With new listings also up in Edmonton, the supply gains in Alberta offset a decline in the Greater Toronto Area, according to the Canadian Real Estate Association report. There were around 177,450 properties listed for sale at the end of August, up 18.8% from a year earlier, but still more than 10% below historical averages for this time of year. TD economist Rishi Sandhi believes the thaw for housing will eventually come. Sandhi noted, "It could be the case that potential buyers are waiting for rates to move even lower before jumping in, especially with the Bank of Canada's relatively transparent messaging that further rate cuts are on the way." He added that he expects healthy Canadian home sales growth over the next several quarters starting in the fourth quarter, although price growth will likely be restrained by tough affordability conditions and loose supply-demand dynamics in British Columbia and Ontario. Heddle described the current balance in the market as one favoring would-be buyers. "I'm of the position that it's a great time to buy if you're in the market and you can afford it and it's the right house because you can negotiate. There's not the pressure to make a quick, irrational decision. I think some of those buyers are coming to that conclusion as well," he said. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. Thanks for tuning in, and I hope you found these updates helpful. Stay tuned for our next episode, where we'll continue to bring you the latest news and insights on the mortgage and real estate market. Until next time, I'm Steve Hamoan. Have a great day.